see standard costing. This is very wide. And in organizations, they set a standard in terms of their cost. That is, they budget a particular amount that they would want to spend. Okay? For instance, they can say probably in a year, our standard or our budgeted, an earning for standard is budgeted. Our budgeted cost we want to spend for direct material. For direct material is 50,000. It means they have a predetermined cost. This is what they want to spend for direct material. Okay? And during the year, while they start incurring expense, they might, this is actual now, for direct material, they might incur either higher or lesser than what they are predetermined or budgeted. For instance, if you not incur, let's say 40,000 instead of the standard of 50,000, the difference, which is 10,000, we call it variance. Variance. It is the difference between the standard and the actual. Most times, especially in this economic situation of Nigeria, most times before you go to the market, you budget. You say, okay, I will buy fish this amount, I'll buy this amount, and you take it to the market. Now, getting to the market, you discover that what you budgeted is different from what you might buy, right? So it means the difference between what you budgeted and what you set as standard and what you actually incur is called the variance. Okay? So we're going to be looking at this in details. Standard costing and basic variances. Standard costing refers to a method of ascertaining cost through the establishment of standard cost, which is compared with the actual to determine the variance. The variance. We'll start. Now that is standard costing. And let's see what is standard cost. That is costing. Standard costing is a method of ascertaining. And let's see what is standard cost, right? The standard cost, which is also known as targeted or target cost, budgeted cost, or forecasted cost, is a budget, schedule, or estimated cost of producing a single unit of a product, a number of units of a product, under specified working conditions. So the standard cost is, like we said, is also known as a budgeted, forecasted, or target, or scheduled. That is a predetermined amount that is supposed to be spent. Okay, so that is standard cost. Now briefly, let's see types of standard cost. The following are the two types of standard cost considered from point of view of time. First one, we have the basic standard. Now let's take the first one, the basic standard. These are unaltered standard, which are used over a longer period of time and do not reflect current conditions. For example, the number of labor minutes, the number of labor the number of labor minutes allowed per unit of product produced. Number of labor minutes allowed per unit of product produced. The second one, number two, current standard. A standard which are established for use over a short period of time and are related to current conditions. So these are the two basic when we are viewing the standard in terms of the time. So talking about basic standard, we said these are unaltered. Now, when a firm is being established, their standard is set. For instance, we said the example, the number of minutes a labor will use per unit of the product. For instance, they can determine that in the manufacturing company, please follow me. They can determine that in the manufacturing company that a labor or laborers are supposed to spend at least 20 seconds per unit of a product to produce a product. 20 seconds on what they determine. Now, it means that they have set this standard when the firm is being established. It is the basic. So most time, a firm might have stayed up to 20 years and this is still there. That is why we say it doesn't reflect the current condition because things might have changed over time and this is still there. So they use this to do other standards. So it's the basic. While the second one, which is the current standard is used for a shorter period of time. It actually reflects current conditions and current happenings. For instance, if we understand that, okay, now the concentration of humans are not as before, so they know how to set the standard. Okay? So the current standard for a shorter period of time can reflect our current condition. Okay? Now let's see if we continue, right? Current standards are further divided into three. A, we have the ideal standard. B, we have the expected attainable standard. We have the past performance market standard. Yeah, and let's write a single note. The ideal standard are costs that represent perfect performance. They assume 100% efficiency. They assume 100% efficiency, that there are no idle time or lost time. The second one, expected attainable standard. These are those standards that are tight. These are those standards that are tight but attainable. They allow for normal machine downtime, employee rest period, etc. Third one, the past performance. Are you there? This is built on conditions which past performance suggests is capable of attainment. Now let me explain these three so that we get this. Now we have seen the two types of standard. Look up. We have seen the two types of standard based on time. So the basic, this is from the onset that does not reflect the current condition. Why the current standard reflects the current condition. Okay? Now, the current, we said, is also subdivided into these three: ideal, expected, attainable, and past performance. Now let me explain this. Now remember, what we're looking at is the standard. That is a predetermined or budgeted cost. That is, the firm will have to set their cost before they proceed to procure. Now, ideal standard is looking at perfect performance. That is, no suggestion for idle time or loss. For instance, if somebody tells you that they work 8 hours, or that you work 8 hours every day in a workplace. Now, for an ideal time, if they are calculating, they might want to calculate these 8 hours. But inside these 8 hours, You might have rest because that is break. That's break period. Okay, let me use, for instance, lectures. Most persons might say every day we have lectures from 8 to 5. Huh? Okay, like today 8 to 5. Okay. Now, if you calculate that based on 8 to 10, 10 to 12, 12 to 2, and all that, now it becomes an ideal because there's no space for rest. But in actual sense, there is a particular gap because you are not exhausting that time in entirety. Sure, understand? Yeah. Now let me come back to this idea. Now let's take for instance now the company can say, okay, it is all workers are working 8 hours. It means they are determining 100% performance. There is no aspect of keeping time if the worker is not feeling fine, or if there is break or idle time. They are calculating based on the fact that everything will be okay. But in a particular work setting, the laborers might be there, but the machine might have fault. So this will not be attainable. So ideal standard is looking about 100% performance, where there are no idle time or no losses incurred. Okay? Why the expected attainable from what we said? Now this is where you now consider that even if we are saying 8 hours is the worker's time, but we recognize that inside these 8 hours, the worker will have to rest. Do you understand? They will have to rest, and there might be some days that the machine might have problem, so we might not achieve that total 8 hours that is already set. Do you understand what I'm saying? That is expected attainable. This one is ideal. You are not considering that the person that these 8 hours might not be effectively used. You are just taking into consideration that every day is 8 hours. Every day is 8 hours. It's not like that. Since it is human, even machine that work most times. I watch. There was a video I watched that robots. You know, most times they use robots. Especially most of these factories. The kind of work they give to the robot. The robot collapse. Robot. After working for several times, the robot collapsed. And the scientist was trying to see how robot was supposed to be, but they collapsed. They worked well, they collapsed. So if robots, if robots can collapse, it means human being will even die. Do you understand? Okay. So the expected attainable is where you are taking consideration of the losses or idle time or break, that you are not assuming 100% perfect work condition. Do you understand? So the past performance standard is where you are looking at the previous standard you have set, how it has been successful, how it has worked thus far. Then you want to bring it to determine the correct standard. Remember, all these three are under correct standard. So that is and that's the right. So that establishing standard cost. The standard costs are usually set by the cost accountant in collaboration with production engineers, designers, work study practitioners, and other managers. We are looking at how a firm establish their cost. How will they determine what will be their cost? Who and who is involved? Definitely, the cost accountant is involved. We also have the managers and the engineers involved, because we're talking about production. Okay? Because they will take several things into consideration. Now, these are the things in which they will look up to set their cost. If you remember the first or the second topic we looked at is what comprises of the cost of a product. We said it comprises of direct material. If you remember, right? We have also direct wages or labor or wages. We have direct expenses. And remember, this three is over what? The prime cost, right?
Yes.
Okay. While we also have the factory. The factory overhead, which can be both fixed and semi-fixed. And we also have the selling. I draw a diagram. If you can go and if you look, you will see an administration. So these are what the cost accountant and all those involved we have to look into in order to establish the cost, the standard cost, the direct material. Now they will have to consider the price of what they are getting those material and how much it will cost them. Also the direct labor, they will have to determine what they are going to pay laborers per hour, the rate, and how many hours are our workers supposed to work. That's how you determine the rate. How much are you paying them per hour, and how many hours they are going to work. And also the direct expenses. We said these are expenses that are not material labor. So how much they will incur here. Now all this gives the prime cost. And also the factory overhead. Now what do we say the factory overhead?
It's same as indirect cost.
Is what?
Same as indirect cost.
It's indirect cost now. I explained this now. I know the prime cost is summation of all direct that can be traceable to a particular production unit. While the factory overhead is they are indirect costs that cannot be traceable. Okay? So they are going to see determine the cost of each of these and sum them together. That determines the standard cost. Now we are going to see how to sum it. Okay, before that, let's say somebody write variance. Now we have seen the standard cost. Let's see the variance. The variance are the deviation from the standard cost. They can be favorable or unfavorable. It is favorable when the standard cost exceeds the actual cost, and unfavorable when actual cost exceeds the standard cost. Say that. And when I started, I said we can have a standard cost as 50,000. Now what it means is that this is after sales. After doing several analysis of all this, they now determine that their standard cost, either for material, is 50,000. That is what they set, the standard. 50,000. And during the year, they now have an actual cost of that same material as 40,000. Now look up. Now, what they mean is that they set a standard that they will incur this a cost, 50,000. But during the year, they incurred 40,000. I said the difference will give us a variance. Which is what? 10,000. Now, from what I gave to you, what is this? Is this favorable or unfavorable? Why? Because the standard exceeds the actual. It means they did not incur up to what they set. Do you understand me? But if in other way around, they set 50,000 as the standard, and they now incur, let's say 100,000 as the actual. So it means what they incur, the actual, exceed what they set as standard. So it means this becomes what? 50,000. Which is what? Unfavorable. Because the actual is now more than the standard. So that is the period. So the variance is basically the difference between the standard and the actual. Alright. Classification of variance. This can be classified according to the elements of cost, which are direct material, direct labor, and overhead cost. material cost, the labor cost, and the factory overhead. Full stop. Right. Variance can be evaluated also using A, mathematical formula, and B, forms which expose deviation from standard. So this is the two ways we can calculate the variance. What it means is that, now how do we determine that the variance has happened? The first one is using mathematical formula. And the second one is using other forms which shows that deviation, which shows that what they set as standard is not the same with what they have actually incurred. Okay? So we are going to see the first one using mathematical formula. This is where we enter into the calculation proper. Now please follow me. Now we are going to see them one after the other. Now we said the classification of these variants can be done on material, labor, and the overhead costs. And this is the thing we are going to see the formulas and also see a question on them. Now the first one is the material cost. Now, how do they determine the cost of material? Please follow me. How do they determine the price of the cost of the material? It is one, the price. Please look up. How do they determine their cost? It is the price and the quantity. The price and the quantity is what will give the cost. For instance, if Indomie is 1,000, is the price, and you bought 5, is the quantity. So if they ask you how much did you spend, that's Indomie cost, what will it be? 5,000, right? Yes. This is the price and what? The quantity. So the material cost has to do with, when we relate it to the variance, it has to do with their price and the quantity. Now the quantity has to do with its usage. Please follow me. So we'll have the variance for the price, the usage. Now you can only use an item when you have it as quantity. So we want to see the cost of material. We want to see if variance occurs in the material. Remember, we said classification is for material, labor, and overhead cost. Because this is what determines the cost of a product. The material, those raw materials you bought, the labor, the people working on it, and other expenses that cannot be traced. That's what we call it what overhead expenses, which is also known as indirect. Now we want to determine their variances. If what we set as standard is the same with what was actually incurred. So the first one, which is the material, we said to determine the material cost. It is a summation of the price and the quantity. I will say the quantity can also be termed as the usage. Because now we are talking about a manufacturing company. If they have this quantity, they will use it to produce. Because the raw material they are not eating it. The essence of that is so they can use it to produce a finished product. For instance, if I want to get the raw material now. Let's say a firm that, let's say bread. Let's say bread. Now, if they buy flour, right? Flour is one of the ingredients. Now, they will have to determine the usage, how they are using this flour to make bread, which is the end product. So it is a quantity they have that determines their usage. So they might set a standard that every day or within a day, this is what we should use. That's a standard. But in actual term, once they start incurring, they might use more or less. So it is the three basic aspects we want to see in terms of material cost. Now, something the right calculation of variances using the formula. They are A, the material, B, labor, and C, the factory overhead. And the first one is the material variance. And let's get the material cost. Now please follow me. Now for the material cost, like I said, to determine the cost is the price and the quantity. And now we're talking about variance, which is the difference between the standard and the actual. So it means to determine what will be the material cost, it will be the standard price times standard quantity minus the actual price times the actual quantity. Standard price times the standard quantity minus the actual price times the actual quantity. Now where XP is the standard price and SQ is the standard quantity on actual production. AP is actual price. AP is actual. Now, this is the cost we're talking about. When I told you to get the cost is the price and the quantity. And now we want to determine the variance, if there is variance. Now look up. Let me say this now before I forget it, just in case. Now in some tests, even in your approved test, you might see this first before this. You might see actual price times actual quantity minus standard price times this. It is still correct, it's still the same. Now the basic thing you should know, remember, is how do we know there's variance? And how do we know if it is favorable or unfavorable? We say it's favorable when the standard is more than what? Actual. And it is unfavorable when the actual is what?
More than standard.
So irrespective of where they are, once you have that knowledge of favorable and unfavorable and what constitutes that, it is still the same. Because from text and even the approved text, you will see yes, that average price times quantity is first minus standard price times that quantity. It will give the same result, but the interpretation is what matters. Now, say this is standard price. That is the price they set as standard they are going to incur. Now, this standard quantity on actual production. Now, this standard quantity will be on actual production, what they produce actually. Then AP is the actual price, and this is actual quantity. Now, this is cost. Now, we want to get the usage, which is the material usage. Now, we said the usage will be based on the quantity, because they can only use an item when they have it, which is the quantity. So, we want to get the variance for the quantity, and it will now be the actual standard quantity minus actual quantity times the standard price. So we have That's the second one. The standard quantity minus the actual quantity times the standard price. Now, in the same way also, like I said, in some text, you will see the actual quantity here and the standard quantity here. The major aim is to know when the standard is more than the actual. You have what? We're going to see that while we're solving. While the last part of the material variance is the price, which is the material price variance. So the material price variance, now he's talking about price. Now usage is quantity. That's why we have to look for the quantity. Now he's talking about price. So to get the variance for the price now, it will be the standard price minus the actual price, and this will be on actual production or actual quantity. So now where XP is our standard price, AP is our actual price, and AQ is our actual quantity. The summation of these two results will give you this. This to confirm if what you did while solving, if you're correct. The summation of the material usage and the material price will give you material cost. So the material cost, like I said, is price and quantity. So we're looking at the difference between what is set as standard as the cost. Or we can tag this as standard cost minus actual cost. So how do we get standard cost? The standard price times standard quantity. Minus how do we get actual cost? Actual price times actual quantity. So the difference gives what is the variance, which is material cost variance. While the second one is usage. Usage has to do with the quantity that's being used. So one will know the variance between what is set as what is being used or what is supposed to be used and what they actually use. So it is the standard quantity minus actual quantity times the price set as standard. So we are going to see an example of how to solve this. Standard cost data I'm gonna yeah. Now let's solve this. Now we said the standard cost data for the production of one bottle of Aka lemon as follows. Now look up. Quantity, now they say the standard, now this is the standard. The standard cost data for the production of one bottle of Aka lemon as follows. The quantity, and this is standard quantity of material B is 10 units. The price of material B, 22 naira per unit. Now they say the actual production data as follows. And this is the standard. This is the actual. So actual production data as follows. Quantity of Aka lemon produced. 2050 bottles. Okay. Price of material B used is 24 naira per unit. And the quantity of material B used is 2,600 units. Now they say required calculate the material cost variance, material price variance, and material usage variance. So that is what we want to do. Now using our formula, so we have the first one, which is MCV. So in case you see an application, MCV means material cost variance. Okay. Now I told you material cost variance. Material cost is the difference between the standard cost and the actual cost. And the standard cost is standard price of quantity, standard price times standard quantity minus actual what? Quantity. So the difference will give us the material cost variance. So we now have equal to standard price. What's the standard price there? 22, I mean? So we have 22 times, what's the standard quantity? 10. Now this 10, we set the standard quantity on actual production. Please follow me. Standard quantity on actual production. So it becomes 10 times, they say this is the quantity of actual lemon produced. This is the actual production, 250 bottles. Please look up. Now, we said this is the standard price. The standard quantity is always on actual production. We are relating what should be the standard quantity on what they actually produced. So this is what they actually produced, 2050 bottles. So we have the standard price, which is 22. Then the quantity of material B is 10 units. Now this will multiply their actual production. That's what we say standard quantity on actual production. So it will now be 10 times 2050. So this is 2,500, right? Minus what's the actual price? They say this is actual production. This price of material B is 24 times what's the actual quantity? 206. Are you there? So we now have 22 times this. What do we have? 451 0 0 minus 4 4 0 0 like this.
Yes.
Now this minus this will give us a value. What do we have? 43 what? 400, right? Okay. Now either you put like this, or the major thing. Remember I told you that this can be here or this can be here. The major thing is to write. Now while you're writing your answer, you must indicate if it is favorable or unfavorable. So this, is it favorable or unfavorable? Unfavorable. Why is it unfavorable? So you can put. This is very important. Very important as your answer. As you're putting it, you must interpret if it is favorable or not. So in the text now, you might see this here. So once you do this, it will now give a positive value as for 300. But the major thing we are looking at now is this interpretation. So that's what's the second one? Now the second one is material price variance, which is MPV, right? Now the price variance is looking at the difference between the standard price and the actual price, okay? Which will be on the actual what? Quantity produced. So it will not be, now we're talking about price, so it will be standard price minus actual price times what? Actual quantity. So we now have what's the standard price? 22 minus what's the actual? 24. What's the actual quantity? 600. Yes. So we have 2600. Is that what you call?
Yes.
That was right. Now 22 minus 24. Now look up. Now this, even without summing down, I know it will be unfavorable. Because my actual is more than my standard. I say, my actual is more than my what? My standard. Yes. Okay? So I use an illustration for why you are going to the market. I said, for instance, if you budgeted, you set a standard that okay, I'll buy for 5,000, and you end up buying it to the standard, and you end up buying it 10,000. It becomes unfavorable. That's the actual. When the actual exceeds the standard. But now we're talking about cost, though not for this level. Those doing accounting. There's another aspect of variance in which if the actual exceeds the standard, it is a gain to them. It is favorable. Now the reason it is unfavorable here is because it is cost. You are spending money. You're spending money. Okay? So now 22 minus 24 give us what?
-2.
-2. 2 times this gives us what?
-41.
41 what?
200.
200. Is this favorable or what?
It's unfavorable.
Very important.
In the example, if you are writing this thing, what is get in case of sign? Like putting it or not is not doing what you
What's that?
What's the answer get the negative sign? Putting it or not is really not doing
Yes, that is why I said in some tests, this is here, why this is here. Even in the approved test. So if you now give like that, it will now be 24 minus 22. So it will now give you positive. But the essence, the why you are interpreting this, even if it gives you positive here with this sign, it is still unfavorable because the actual is more than the standard. Do you understand me? So it is here that interprets your answer. Do you understand me?
Yes.
So what I'm saying is while you're reading now, you might go through the text and you might see that this is here. Why this was still the same. So that you don't say, what's happening here? Why the third one is what? Can I finish one?
Yes.
Material usage variance. Now usage, like I said, has to do with quantity. Okay, so it will now be, now we are looking at the variance. So it is still standard quantity minus what? Actual quantity times what? Standard price, not actual price. As the standard price. Okay, so what are standard quantity? Standard quantity should be on actual production. So it is now 10 times this, right? Please don't forget, you can even jot it down so that you don't. Minus actual quantity is what? 2600. Times what's standard price? 22. So this minus this one where? Huh? 100. Okay, multiply by 22. Huh? 22. Favorable or unfavorable? Or what? Unfavorable. Now, like I told you, I said the summation of the usage and the price gives you the cost. Now add it, let's see. This plus this. Is it giving us that?
Yes.
Huh? Did it give you that?
Yes.
So that is to also check if what you use is correct. So that's material. Now let's see that for labor. Okay, now we want to see the second one. Now we have looked at labor, and let's see that of the labor variance. The same way, now remember, when you have raw material, the raw material will not work on itself. It is labor, it is people that work on it, right? Yeah. So the labor variance is still in three aspects. The labor cost variance, now what comprises of labor cost variance is the difference between also the standard cost minus the actual cost. The standard and actual. Now how do you determine, look up, please stop writing. I don't want to just write the formula, I want you to know why the formula is there. So that in exam condition, you don't just, you understand why it's there and generate it. Now, how do you determine the cost of labor? How do you determine what you pay labor? It is the hours they have worked multiplied by the rate you are paying per hour or per the time. The time they have worked multiplied by the rate you are paying by that time. For instance, if it is determined, probably like we saw in the basic standard, remember type of standard, the basic, it is determined that, okay, you are working every day 5 hours. 5 hours, that is what you want to work in this our company, 5 hours. And we are paying per hour. We are paying per hour 100 naira. So for the company, what will now determine the cost, their labor cost? It is the hours the people have worked multiplying by what they are paying per hour. So it will now be 100 times 5, which is what? 500. So this will be the cost. So what I'm trying to say in essence is that the labor comprises of the hours, that's the time, and the rate. The hour, the time worked, and the rate you are paying for that time. So if we now relate it to the variance, which is standard minus the actual. So how do we now get the standard cost? It is still standard hour times standard rate minus actual hour times actual rate. So it means they have said that, okay, this is our company, oh please, it is 5 hours of work, I will pay them 100 naira per hour. But while they are working, they might not work exactly with standard, which give rise for variance. They might either work, let's say, due to current, that's why we have current standard. Remember the two types, basic and current. Due to current standard, we now discover that our price of things have increased, so it is no longer like that. People can no longer be paid 100 naira per hour. So they might be paid 150. So you see that the actual rate now is now different. Okay? While the hours work might also differ. So that is labor cost variance. So we said where S rate stands for standard hour, SR stands for standard rate on actual hours. The same way we did for that standard price. Was it standard price? So standard rate on actual hours of production. Thank you. While AH is the actual hour and AR is the actual rate. Standard hour on actual production, not standard rate. Standard hour on actual production. They want to see the standard hour on what they have actually produced. Then the standard rate, actual hour, actual rate. And that is for the labor cost field. While the second one has to do with labor rate variance. Now rates, now we're talking about what they are being paid. And that would be the standard rate minus the actual rate multiplied by the standard. And the actual rate multiplied by the standard hour. Where our SR is same thing as standard rate, our AR is actual rate, and SH is standard R.
Standard rate on actual production. On actual production. Standard rate on actual production.
Standard R, actual.
The labor rate.
Labor rate variance.
It does not have supposed to be on the
Actual. So it's what?
No, you have to where SR equals to standard rate on actual production.
It's SH. There's no.
SH, the other one.
Sorry, please. Now, why the third one is looking at efficiency, labor efficiency variance. So you can complete it where SH is the standard R, actual production, this actual R, and this is standard. And this is the thing. Now the same way, look up, this plus this will give what? This. Okay? So let's see this question. Also, like I said, in some text, you can see this coming first and this. The standard cost data for the production of one bottle of Akalemon are as follows. Hours for the production of one bottle, 10 rates per hour, 2 naira 4 kobo, that's 2.4 per hour. So this is the standard. Now they said the actual production data as follows. Number of bottles produced, 5,000. Rate paid per hour, 2.60. And the hours worked, 49,600 hours. So we want to get what will be the labor cost between them. So it will be our standard hour times standard rate minus actual hour times what? Actual rate. So we now have our standard hour. Remember our standard hour will be on what? Actual production. So what is standard hour? 10, abi? Times 5,000. This gives us what? 50,000. Times what is standard rate? 2.4, right? Okay. Minus what the actual R? 49,600. Times what actual rate? 2.60, right? So help me please. 50,000 times 2.4. 120,000 minus what is this?
128,967.
Like this?
Yes.
So what's the difference?
8,960.
Is it favorable or unfavorable? Favorable. So it's very simple. So that's the first one. The second one is what? Labor what? Rate variance. And the labor rate has to do with the difference between the rates. Which is standard rate minus actual rate times actual hour. What's our standard rate? 2.4. What's actual rate?
Actual rate is
2.60 times what the actual hours work? 49,600, right? Okay. So 2.4 minus 2.60.
6.4. Yeah? Okay, minus 0. Minus 0.
Times 49,600. 9,920. Favorable or? Unfavorable. Okay. Then the last one is what? Third one is labor efficiency variance. So it will be standard R minus actual R times standard variance. So our standard R will be of what? Actual production, right? So now it's 10 times 5,000. That's what? So hope you know how we are getting this.
Yes.
Who's saying that number? Then actual R, what the actual R? 600. So that's 600 now. Times what our standard rate? 2.4. So 50,000 minus this gives us 400 times 2.4. 960. Is it favorable or favorable? This one about that. So if you add it together, how will you get to us?
It's correct, sir.
No, no, it's correct. This is minus, minus, this is plus. If you add this together, subtract this. Because they are unfavorable now.
Okay.
So you subtract it from this. So 896 plus this, yeah, minus this.
9920.
Did it give us that?
Yes, give us your favorite.
Okay, what I mean is this minus this. Did it give us this?
Okay. So even though you had unfavorite plus unfavorite plus give you
Did it give us what?
no, what we are looking at is the first one.
Is the first one I said these two. So because this is unfavorable, this is favorable. So they can't merge. So this minus this gives us this which is unfavorable. Okay, the third one. Now, the factory overhead variance also have to do with, I remember we said these are indirect, okay? So they also have a fixed and a variable. So it will comprise of the budget, the efficiency, and the volume. The volume has to do with quantity. The efficiency also has to do with hours, while the budget has to do with the total cost. Okay? Now we're going to see them one after another. And the first one is these three comprise of overhead budget variance. Budgeted overhead cost minus actual overhead cost. And the first one is budgeted overhead cost minus the actual overhead cost. Like to give overhead budgeted variance. It means what they budgeted as what they will spend in terms of overhead minus what they actually spent in overhead. Why the second one? Now, the factory, we are seeing the material, labor, now the overhead variance. Now, this comprises the formula. Now, this is overhead budget variance. It means what they budgeted that they will spend is different between what they actually spent as per overhead. Now, overhead efficiency variance. Now, it is closely related with the labor that we have done because it has to do with standard hour minus actual hour. Now, but this is quite different. If it's for the labor, it will be on the actual production. But this one, we have what we call SOR, which is the standard overhead rate. So standard hour minus the actual hour multiplied by the standard overhead rate. Now the standard overhead rate is given as standard overhead for the period divided by the standard hour. Now this is standard overhead rate with the standard overhead for the period divided by standard hours for the period. Now the truth is that this will be given in the question. Okay? So the next one is the volume, which has to do with the quantity, the hours, sorry. Standard hour per period for the period minus the actual overhead for the period multiplied by the standard overhead rate. Okay? Why this is overhead cost variance, which is closely related to this, the standard overhead cost minus the actual. Now, the summation of all these gives the cost. Please follow me on. The same way, while we are looking at material and labor, we saw that the material cost is the summation of the price and the quantity, the usage. The labor cost is the summation of the rate and the efficiency. That's the same way, the efficiency, the volume, this gives the cost. And that's the summation. Now, why this? Now, the reason I draw this line, now look up. Overhead calendar variance. Now, we said it is the difference between the actual number of working days and the standard number of working days. Now, what it means is that they might have a standard working days as 100 days. That's a standard, 100 days. But while they are working, they might not get up to this 100 days, probably due to remember, we considered ideal, standard, and expected attainable standard. If you remember, we said the ideal standard is where they do not consider any idle time or losses or whatever. While this expected, you consider some of this. So they might have a standard number of working days, while the actual might be lesser. Let's say some days. Now the difference might be, some of them might be public holiday or the machine have issues and all that. The question might want to ensure that you include this. There are two ways the question might come, whereby you consider that there is a calendar variance. It means that the number of hours they worked, once you are considering that they work for 77 days, will not be the same. Now, this efficiency, if you watch, it is talking about hours. It means the number of time the laborers are working. Now, if they give a standard hours and they said without considering calendar variance, it means they are telling you to take the number of standard hours they are given. But once they said consider the calendar variance, it means you will now actually check what is the actual days they worked, which might not be up to the standard. Then you include this. I think if we start solving the question, you will get what I'm actually saying. So for this is the formula that has to do with factory overhead.